hot like Sunday. Oh, no.
Thanks for coming.
Thank you.
You have to wait for the atomic clock.
Waiting for the atomic clock.
Okay.
I think everyone are all unmuted and recording. So I think we'll go ahead and get started.
All right.
So it's May 15th. We're with Lynn here, going to do the March Director's Cut. Just really quickly, I'll just introduce myself. I'm Katie Harsager. I'm the new Public Information Officer with Department of Mineral Resources. And so hopefully you've gotten my contact information through today's invite. Otherwise, we'll get started. And if you have any questions afterwards, we'll hold those till the end and go from there.
All right. Thanks, Katie, and welcome aboard. North Dakota native, right?
Yes.
Mohall?
Yes, Mohall, North Dakota.
All right.
Yeah.
Mohall, North Dakota native. So it's nice to have you on board. So thank you for everyone who came to the webinar and also those who've logged on. It's May 2018, so we're talking about March production, February and March production. And there's just that 2-month lag of gathering information. I heard a fascinating presentation late last week on something called blockchain, which has the potential to shorten this whole time frame and maybe get to the point where production can be reported and audited almost in a real-time basis. So we're kind of excited about that, and we're looking at that technology. But the way it is, we're talking 2-month-old production. So think back to the month of March. It was pretty cold. We had a couple of snowstorms. It wasn't as cold as February. We didn't have any weather where it was absolutely too cold to hydraulically fracture wells. But we did have some windy days. I think we had 9 days out of the 31 that it was too windy for hydraulic fracturing operations, and 2 significant precipitation events that took people out of the field for a couple of days there too. So keep that in mind as we talk. So oil production down very slightly, 13,000 barrels a day, still well above that important million barrel a day number, and also in a really good spot as we launch into spring and increased activity as we start to see activity pick up and potentially see major increases in production. So down about 1% on the oil production. Natural gas, on the other hand, set a new record. So up not quite 0.5%, 0.4%, up 10 million cubic feet a day. Not a big increase, but again, we continually see natural gas production outpacing oil production. And it's one of those months when gas is up, even though oil is down. And so that really informs and presses the challenge for gas capture. It just keeps the pressure on in terms of gas capture. We saw a turnaround in the number of active wells. So we're at a new all-time high, 14,457 active wells operating in the state. So that's a new all-time high. Keep in mind, we think the ultimate well count is going to be around 60,000 in that neighborhood. So we're still less than a fourth of the way there. You saw oil price, a significant increase to today. That's the North Dakota Sweet price there. West Texas Intermediate's actually at $71, I think, today. And so the typical Bakken operator nets the average of those two prices. But when you see $59 oil, that's plenty high enough to stimulate more activity and more investment in the Bakken. And that's a good place to segue off and talk about the big conference that's coming next week. The theme this year is Bakken Now. It's going to be right here in Bismarck, Tuesday through Thursday. We're getting close to 3,000 people registered. All the booths are sold. We even have some outdoor exhibits. Some people are cooking lunches and food and giving them away. And it's a great show. It's the biggest show in the northern U.S. So we're seeing, I haven't seen this kind of optimism and excitement probably since 2010 in the oil and gas industry. So it's really great to see the industry back on its feet with a healthy balance sheet and excited about investing money in the state of North Dakota. OPEC is really struggling. They're in deep discussions about how are they going to manage their production cuts. They had extended production cuts through the end of this year, but now Venezuela's exports are completely collapsing. I don't know if you saw on the wires, but there was an arbitration that awarded ConocoPhillips a $2 billion arbitration award because the country of Venezuela had seized a bunch of their assets. ConocoPhillips seized Venezuela's tankage and oil in the Caribbean. And so Venezuela's production continues to collapse. In fact, they're getting pretty close to where North Dakota will be producing more oil than the whole country of Venezuela, which is a very significant thing. And then, of course, we're looking at the reinstatement of sanctions on Iran. And that will potentially take 1 million barrels a day off the world market. So the other OPEC countries are gathered together trying to figure out how they're going to offset that and maintain the supply-demand balance that we saw. The first quarter demand in India was up, well, I guess it was last month. Crude oil demand was up 4.5%. So we continue to see Asia or the Asian continent demanding more and more and more crude oil, and the oversupply is gone. So it's going to be a tricky job of maintaining that balance so that we don't see a massive price spike, an upward price spike. So pretty much it looks like the downside risk is gone for now. And the greater risk is that we see some type of supply interruption and we have a major upward price spike, which will put a lot of stress on infrastructure and on the Bakken operators in particular. So I already talked about it a little bit. March was not bad, but it sure wasn't good enough for really increased activity to bring us back to that record production. Most noticeable there was that the inactive well count only went down 1, and the number of non-completed, drilled but non-completed wells actually went up 15. So again, in the month of March, the weather wasn't great. The price still was a little bit on the low side, and so activity hadn't really increased yet at that point. When we look at Fort Berthold, that's really where we saw the biggest increase in rig count. Went from 13 to 17 rigs. So that's a pretty significant event. Essentially all the rigs that were added to our rig count in the month of March went to the Fort Berthold reservation. And so you can see that industry has recognized how rich that resource is. And I think they were very encouraged by the discussions that were held a couple of weeks ago here in Bismarck with regards to infrastructure investments and rights of way. And it was great to see industry and BIA right-of-way people in the same room talking about how can we do a better job and get these rights of way approved in a quicker fashion. I talked about record gas production and the pressure on flaring or on gas capture. So statewide Bakken was at 89%, statewide total 88% capture. That tells us that with summer coming and increased activity, 88% capture on November 1 is not going to be easy. It is going to be a real challenge. So I expect to see a lot of pipeline crews, a lot of compression construction, a lot of natural gas plant construction out in the western North Dakota communities. It's going to bring a lot of out-of-state workers back. That's what they do. They come and build things like that, and then they leave for the winter. So we're going to see another surge of workers from out of state laying pipelines and building compressor facilities and building gas plants. First month in a long time that there's nothing new to report on federal rules. Not a single thing happened in the last month on the federal rule front. So nothing to report there. We're still involved in litigation on several of those rules. We are very excited that Secretary Zinke is coming next week, and we're sure going to sit down and talk to him about all those BLM rules that are in the director's cut. The last thing I want to touch on is the break-evens. So once a quarter, we go back and take a look at break-even prices. And I know Justin does this on a very regular basis. And if I can't answer the questions, maybe he can. We saw a modest improvement. So virtually everywhere in the Bakken, except Burke and Divide County, is now above break-even. So what we're seeing, and I looked at the rig map today, we're starting to see a significant number of rigs moving outside what we call the core area to drill in some of the outer reaches of the Bakken, where some of the smaller operators have made acquisitions. So at $71 West Texas Intermediate, really, like I said, every county except Burke and Divide is above break even, and in Divide County, I just didn't have any data, not enough new data to do a new analysis. But I think some of the prospects in southeastern Divide County are actually still economic. So that's our report. I guess if you had to come up with a theme, it would be let's get ready to rumble. $71 West Texas Intermediate and good weather coming. And starting from 1.16 million barrels a day, we're excited about what 2018 and 2019 looks like for the state of North Dakota. We'll take questions.
Have the road restrictions come off in the Bakken?
Thank you for asking that. I looked at the road restriction map this morning, and they have not. The major highways, Highway 2 and 85, Highway 22, and the interstates, the road restrictions are off. But I looked at county and state highway road restrictions, and Williams County, Divide County, Burke County, Dunn County, and McLean County, pretty much all still on lockdown. McKenzie County is the only one that has lifted its road restrictions, and they've got that weather thing. So if we get a rain or a snowstorm, they'll be back on. But pretty much the entire oil patch is still under road restrictions. That should be ending. Typically that ends sometime shortly after Mother's Day. Sometimes it hangs around till almost Father's Day. I don't think that'll happen this year, but we're close. That's still going to dampen probably even into the May production. So when I talk about record production, we're still kind of putting our finger on June as the month when we think we're going to see that, because we'll be out of the weather window and road restrictions will be off.
Speaking of the weather window, was it last year that there was some voluntary restrictions put on because of drought? What's the possibility of that this year?
Yeah, that's great. And I forgot to repeat Amy's question, but it was about road restrictions. The folks on the webinar probably picked that up because I said the word enough times. Yeah, the question was, last year there were some voluntary restrictions because of drought. And is that a possibility this year? And we're not in severe drought yet, but we're dry. And you're right, there were companies who shut wells in because they had flares and that sort of thing, and those create a prairie fire hazard, as well as some of the operations in terms of building locations and that sort of thing present hazards. And so it's a real possibility for later this summer. Probably wouldn't see anything like that until a July, August time frame. So we still think June's going to be a really great month.
What did you mean when you said break even percentage?
Oh, thank you. Question was, what do I mean by break even? I do my analysis on a pure, will a well make its investment back? So what I do, we get pretty detailed information county by county from operators when they present exhibits at our hearings. And so I look at those and look at the cost of drilling and completing a well, and then compare that at today's oil price to the profit from that well. And if that well will make a net profit, if it'll pay its investment back, then it breaks even. So, sometimes in that scenario, it might take 10 years to get their investment back, but that's what my break-even number indicates, is it just pays its investment back.
In the Bakken, you said?
Correct.
Okay.
Now, there are some other break-even analysis. I think occasionally Justin from the Pipeline Authority presents them, and I think he uses a 20% internal rate of return, which means that the investors aren't just getting their money back, but they're making a 20% rate of return on that, which if you could get that at the bank, you'd be mighty happy. Of course, there's a lot more risk drilling an oil well, but yeah.
I would do a follow-up from that in the chat here. Just with the break-even prices being $17 per barrel historically, where does that sit?
Oh, great. Yeah. So the question was historically, where does that fit? And those are not record lows, but they're near record lows. I think the lowest we've ever seen for a statewide break-even was $15. So that's an extremely attractive investment. And I was visiting, I guess it's about a month ago, 6 weeks ago. I was in Denver and visited a number of CEOs, and they were talking about the various oil plays, Oklahoma, Texas, North Dakota. And at that time, at those oil prices, it was pretty much a toss-up where you wanted to put your capital investment. So just depending on where they had acreage and could invest their money and market their oil, that's where they were putting their money. Slight changes would tip that. So for example, when the Oklahoma legislature raised the severance tax for crude oil in Oklahoma, that tipped the scales in our favor. And we're actually seeing that to some extent in 1 or 2 rigs being added by some operators that are big in the Oklahoma scene. Is that it?
Are there enough frac crews to handle increased production?
Yeah, so the question was, are there enough frac crews to handle increased production? And the answer to that is there are just enough frac crews to keep up with the 60 rigs that we have today. I was in Grand Forks last week and had a chance to visit with one of the major frac operators. In fact, 2 of them were there. And they are doing everything they can to hire people. They have more business than they can actually serve. And so if we see what industry's talking about, which is moving from 60 to 69 or 70 rigs this year, there will not be enough frac crews to service 70 drilling rigs. And they're going to have to staff up and bring more equipment in. And I think you maybe I saw some of the information from Job Service North Dakota. They had a job fair, 2,000 job openings, and 200 people showed up. So, you got 1 person showing up at the job fair for every 10 jobs. That's going to be a true choke point or a restriction on growing production and activity.
Lynn, can you talk more about the 60,000 well forecast? What is the timeline on that and what is it based on?
Okay, great. Yeah. So the 60,000 wells is based on the geologic models that we've seen presented by the Bakken operators with 4 layers of Three Forks in the very core center of the basin, tapering out to just middle Bakken at the outside edges. So kind of township by township, there's less wells per pad or less wells per spacing unit. So the 60,000 is the sum of all of those. And that is over a time frame. I think the end of the drilling window for the 60,000 wells is in the mid-2030s. So it's a long ways off. I mean, we're talking 15, 17 years of drilling to get to that point. There's a lot of conversation around that number. We have already signed off on the paperwork. We haven't permitted 32,000 wells, but we've signed off on the paperwork to approve 32,000 wells. And that gets us halfway there. I think, maybe the biggest tell is that the Eagle Ford play down by San Antonio, Texas, roughly the same size as the Bakken, is at 32,000 wells and has 75 rigs running. So, that's really kind of our analog and our go-by. It really affirms, I think, that number. What it's based on is the geology.
You also mentioned that they're going to have trouble getting to the flaring goals. And I see that you even remarked that is that the plant at Tioga is 96% capacity.
Yes.
I assume most of the other plants are running at capacity, and Demicks Lake is probably a year away. So how is that going to affect all this?
Sure. So the question was plant capacity and how does that affect this? And you know, the answer is pretty clear that until I guess it's the third quarter of this year is the first of our 5 new natural gas plants that comes on. So that tells us that the second and third quarters of this year are going to be an extreme challenge. If we see people really go after these 900 non-completed wells in June and July, like we anticipate, folks are going to be very challenged to capture that gas. And so then starting in the third quarter of this year, we start to see gas plants come on about every 3 months all the way through the year 2019. So the real pressure point is going to be mid to late 2018. And then we should start to see some relief on the gas capture. But so there's what, roughly $3 billion of investment, I think, that's going to occur in the second half of 2018 and through 2019 to deal with that situation. But the timing is just not going to work out. I mean, there are going to be issues, especially I think this month, the Robinson Lake plant is down for maintenance and repairs. And so we've got some serious issues around Newtown, between Newtown and Stanley, with gas capture.
Do you know the volume of gas that was flared in March?
I do. The volume flared in March, 258 million. It was almost identical to the February volume, 258 million a day. And again, that's enough for 2.5 modern gas plants. So it tells you that they're making a good investment, the 5 that are playing. We'll move to Justin.
All right.
Oh, we get to pick on Justin.
I said his name enough. Maybe you thought of some questions. Perfect.
I'll move through them pretty quickly, so just hold on. So good afternoon, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. I'll get right into some of my regular updated material. Bump into slide 3. I'm just taking a peek at what's going on around the rest of the Williston Basin. No major changes at all. And then again, as we saw on slide 4, the 4th consecutive month of decreased oil production for North Dakota and 2 consecutive months of natural gas increases. And so how the oil was estimated to be moved in the month of March, some shuffling around here between pipe and rail. And so we saw percentage-wise a decrease in the utilization of pipeline and an increase in rail transportation out of the region for March. So slide 6, when we look at, again, this historical trend in blue, that is that pipeline market share. We've seen now in 2018 several months of decreasing pipeline utilization and increasing rail utilization. Most of that, again, is going to be all market driven, taking a look at what's happening with the Brent WTI spread, what's happening with the North Dakota discount to WTI. I believe here in just a moment I'll touch a little bit on pricing. So if we go to slide 7, this is an updated estimate for crude by rail out of the region. So again, continuing to bump up, now somewhere in that 270 to 290,000 barrels per day estimated for the month of March. Where those barrels are heading, again, some dynamic shifts here taking place. Several months ago, we were looking at almost exclusively West Coast deliveries of crude by rail out of the region. That has since shifted again here in 2018, and now looking at about 50-50 mix between East Coast refiners and West Coast refiners for that crude by rail out of the region. When we look at pricing from around the U.S., And this is that same February timeframe, the most current we have of what the refining industries were paying in these various PAD regions. And so if you look at PAD 1 on the East Coast and PAD 5 on the West Coast, they're back closer to on par. There was a time period where the West Coast was at a premium to the East Coast. And that's when we saw, again, those barrels being delivered primarily to the Pacific Northwest. Again, has shifted as pricing and market has evolved here over the last several months. Looking at pricing as of today, as of this morning, the Brent WTI spread widened even further. So it came down for a period of time around that March, but it's widened again to over $7 per barrel spread. I would say that that's definitely a market situation that would encourage marketers out of the region to utilize crude by rail over the pipeline markets out of the region. When we're also taking into account what's taking place with the WTI North Dakota spread, that has crept upwards as well. We're looking at right around $5.50 per barrel below WTI. So when you include North Dakota discount to WTI, the WTI spread between Brent, you're looking at about $12.50 to $13 spread between the Brent or the world oil prices and that North Dakota price. So again, those marketers that are choosing where to ship that barrel and where to send it, rail rates are very competitive right now. They're working very hard to stay competitive with the pipeline networks. And so again, we're seeing that in the numbers that come to play here over the last several months as more barrels are moving on the rail network. Some more shifts on the truck import exports out of the region. And so slide 11, looking at decreasing exports, so less barrels moving out of North Dakota north into Canada, but still relatively high volume of barrels coming down into North Dakota. I know each month there's several questions about this. I have been able to dig and find a little bit of additional information on the import volumes, at least coming into North Dakota. From what I understand, the majority of those barrels coming into North Dakota are a heavier sour barrel that'll get blended with a lighter, sweeter barrel for North Dakota, and typically those barrels then get put onto the rail network for deliveries to coastal refiners. And so again, they're taking cheaper, lower quality crude oil from Canada, bringing it in North Dakota, blending it to meet a certain specification, and then marketing that around the U.S. On the gas flaring side, again, very little change percentage-wise, and very little change for, again, why that gas is being flared out of the region. Again, the challenge is going to continue to be going forward. That orange piece of the pie, the wells that are connected to a gas processing plant, to a gas pipeline system that just simply does not have enough capacity to handle all the gas being produced from that pad. I'll move forward quickly to slide 14. This is that update on new wells selling gas and new wells producing gas. We did see the new wells producing gas to outpace connections for the month of March. And so that's something we'll keep an eye on, make sure that that's not some type of trend that's occurring, that it's just a one-off blip. But again, at least for the month of March, more wells were brought online producing gas than wells that were connected to gas gathering. And then slide 15, this is just piggybacking on some of Lynn's comments about gas processing plant capacity, where production may be headed over the next couple of years. And where you see that red and gray line diverge or fork from each other, that is my forecasted natural gas production going forward. In both scenarios, production will exceed processing plant capacity beginning here this summer until those additional plant expansions and new builds come online here later this year. And I did include for the first time here on slide 16, this is just an updated graphic, just continuing. That previous one ends and it looks like things are okay, and they are for at least a couple of years, but when we look long term, we do expect substantial gas production increases out of the region to the tune of over 4 billion cubic feet of gas per day being produced. And so we can expect in the coming years additional investments in processing plants, the associated pipeline networks to connect those facilities to the markets. So with that, I'd be glad to answer any questions on any of these topics.
I do. I'm curiosity. You said it's a heavier sour crude coming from Canada.
Yep.
Is that tar sands oil?
Not tar sand, so it's going to be likely Williston Basin production just north of the border that's being trucked down
So
south.
it's
And so
national.
typically, right around a 20-degree API gravity. So a Bakken barrel is about 40 to 45 API gravity. So a lower number is a heavier crude and a higher sulfur content, around 4 to 5% sulfur, versus a light sweet barrel like the Bakken. And so they'll blend, X number of Bakken barrels with a heavier sour barrel to create something that meets a certain specification.
The oil that is shifting from pipeline to rail, do you have any information about whether that's leaving Dakota access or what pipeline?
It seems to be impacting all pipeline networks. My understanding in conversations that, again, barrels are just, with production decreasing, we saw imports increasing. Again, that's where most of that increase in the rail network came from. Increased or high volume of barrels coming down from Canada, and again, just barrels shuffling off of the pipeline systems that didn't have a firm commitment on one of those networks.
So why is the pipelines less used compared to rail then?
Just market conditions, and so that barrel, the marketers that are making the decisions out of North Dakota will decide, if I take my barrel of Bakken oil, do I ship it on this pipeline network to receive X price, or do I put it on a rail network and get Y price? And so then again, they're looking at what the market's doing and trying to make the decision that makes sense for their company. Any questions?
I just have one on here. So what is the capacity right now of processing plants scheduled to come online in 2018, if there is any? And then when is it expected, I guess, just to come online? Is there a specific date?
Yep. So as far as numbers, the graphics behind this slide 15, I don't have those committed to memory anymore. I do have a table on my website that does have those 5 projects, the timelines and the volumes. And so if you go to northdakotaPipelines.com, gas plants, there's a table there that has each of these projects laid out as far as their capacities, the timeline coming on, and then year by year totals at the bottom for processing plant capacity. But so if that table doesn't work to get them the answer, they should just contact me and I'll make sure and get them the correct answer.
This is an off-the-wall question. I was just listening to something on this. Is it line 3 that goes to northern Minnesota and having all the problems with that?
Correct. Yes.
Yeah, how is it affecting us? Probably our oil doesn't get to that line, but does it affect us?
It doesn't directly impact North Dakota at this time. However, the long-term outlook, depending upon the timeline and expansion, if it does expand or what the volume is going to be, may impact the overall Enbridge mainline system, which may have a trickle-back effect to North Dakota. But at this time, it's real difficult to say with any certainty what that might be.
Any other questions?
Is the Dakota Access Pipeline up or down in commercial oil they're bringing through? Or?
Correct. Most of the pipeline systems are all reporting, or my understanding is that they're down in volumes for the month of March at least.
Do you have any information about a new NGL line proposed to serve the next lake plant?
Off the top of my head, no. So the question was any information on NGL line. The expectation is that all the new processing plants, as they expand or get constructed, they're going to need additional NGL transmission systems to connect either to a rail facility or to one of the existing pipeline networks out of the region, which would be, again, either One Oak, or if they have any ethane that would be delivered to Canada, those type of projects.
So since the pipeline production's down, is that due to the weather that you was talking about?
No, that would be primarily due to just the market conditions. Again, where that barrel gets marketed, what the transportation options and prices are with various modes of transportation. Okay, well, thank you very much.
Like the other